So I want to kick off this conference with my take on the national forecast. I really want to focus on two issues, both of which relate to the same question, which is the next recession imminent? And I pose the question, is the expansion old and ready to perish? And the second one, can the expansion withstand a rate increase? And these are both related to a personal portfolio management question, which is now the time to switch from equities to bonds? I'm going to tell you that the expansion is going to end, is not going to end anytime soon. There's no recession in the forecast, and you can still stick with the equities market. In fact, every day they become better and better bargains. So you've got to jump in and grab them while you can. So we've been working with four scenarios for a long time for the economy. That's the normal 3% trend growth that the United States has had since 1970. And this is what happened in the 2008-2009 downturn, where we fell below trend, and we've actually been falling farther and farther below over time. So here are the four scenarios. The optimistic scenario is that you get supernormal growth and get back to that trend line. The second scenario number two, is whatever got us below the trend line is permanent, not going away, but we're going to revert to the 3% trend line that we've had since 1970. Then there's a 2%, sometimes called the 2% new normal. And then the fourth scenario is an economic downturn, maybe followed by 2% later on. And you can see that minus 25% at the end. The difference between 2 and 3% on a year-by-year basis isn't great, but when you have the power of compounding, it matters big. The U.S. Great Depression and Greek GDP have both fell by about 25%. So at the end of the decade, we may have had the equivalent of a Great Depression in terms of lost GDP. It's a big puzzle. Our take on that is we've held tightly to that optimistic scenario, getting us back to trend line. We kind of thought there was a balanced risk on the upside and downside. We're slowly abandoning this idea that we're ever going to have a real recovery. And that leaves us with these three scenarios. The downside scenario is the recession. So I want to make some comments about, are we close to that? But before I get to that, I remind you of the Ecclesiastes in the Investor's Bible. There's a time to weep and a time to laugh, a time to mourn and a time to dance, a time to retire debt and a time to, time to issue debt and a time to retire debt. I want to comment about debt. I went with students to Greece. And we saw the damage that inappropriate levels of debt can do. At your personal level or your business level, you've got to know that in a recession, income flows weaken, making debt service difficult, so you lose your job. But in addition, asset prices fall, making it painful to reduce that debt by selling off assets. So you want to be light in debt when the recession risk elevates. So I'm telling you that early in expansion, debt's okay, but later on, you've got to lighten up that debt, move away from debt into secure treasury bills. So here's an example. I'm going to show you several of these images, so I want you to be able to get the message. I know I have your attention only for about 2 minutes, so listen to this, and then the rest will kind of flow over you. This is a chart that has the vertical row in the middle. That represents the cycle trough. To the left is the economic downturn. So this shows you what happened in 1954. Real value equities declined a little bit before the cycle trough, and then you're up and running through that expansion, getting a growth rate of around 50%, a little bit less, a little bit more than 50% in terms of appreciation. Thanks for that arrow. I thought, who's in control here? Has it not been up there at all? The first time? Oh, it was? Okay. So I'm controlling that with this, okay? All right. So that's the real appreciation of the S&P in that early 1954 event. This is 1958. This is 81, 70, 75. 80, 82, 90, or 2001. That's 2001 event, and here we are now. A big V. What I want to bring your attention is that to the left of that vertical line, equities values declined by about 20 to 30%. So the ideal thing going into recession is to sell off your equities and then buy back at the trough. The worst thing to do is to hold on and then get frightened to death and sell at the trough, because then you don't get the second stroke of the V, you don't get that appreciation. So it's not just equities that decline, but everything else. So this is an example of if you had bought a one-year-old Learjet that cost $13 million new, you could have sold that in 2011 for only $8 million, which is tough if you owe a lot of money. If you owe $13 million, you can only sell the asset for $8 million. That doesn't sound too happy. Home prices are the same thing. You know, we had that force of self-collateralizing loans in 2003 and 2004, something that our colleague David Schulman is going to talk more about later on. So asset prices decline. You're not going to be able to get out from under debt in recessions when asset prices are declining. You can't sell out those assets. You're not going to feel good about it. So the basic message is that debt and equity are a wise choice early in expansion. Leverage is your friend. A lot of people think leverage is a dirty word, but early in expansion, you want to borrow to acquire assets that will do the debt service and draw down the loan balance. You want to retire debt and switch from risky equity to safety of treasury bonds, really bills, short-term instruments, when the expansion is old and the next recession is imminent. Leverage is a dirty word. So I'm asking, are we close to that point now? Do you really have to unload your equities and move into treasury bills because that next economic downturn is imminent, and and the stock market's going to get a whole lot worse than it is even today? And my answer is no. But these folks who are cascading downward are happy because they're holding treasuries as a roller coaster of equity values are declining. So the expansion is old. This expansion is old in terms of calendar time, but not so old in terms of GDP decline. And I just put all these up because you've seen the image. We're looking at what's happened during expansions. The one that I want to bring to your attention is the most recent one here, which is so-called Bush-Obama. You can see that in terms of age, if you add one more quarter to it, because we're in the third quarter, there's only 3 of these expansions that have been older than this one. The Kennedy-Johnson expansion, the longest one was the Bush-Carter expansion, and also the Reagan expansion. So if you kind of do the arithmetic, it makes it seem as though the next downturn is imminent, because it's unusual when, in a sense that only 3 out of 10 lasted longer than than this one has. But this is by far the weakest expansion we ever had. The GDP growth is very low. A lot of stuff that's happening in the economy is very unusual. It makes it hard to forecast. But if you thought of as age as measured in GDP time rather than calendar time, this is not a very old expansion. The other thing that's very, very important is this is the employment to population ratio, which again declines in these recessions to the left of that vertical line, and then tend to elevate during the expansion as a fraction of Americans employed drops precipitously in the recession and then recovers during the expansion. And this is where we are now. So there's been virtually no improvement in the employment to population ratio. Sure, the unemployment rate has fallen, but that's mostly due to discouraged workers. The relevant thing to look at is the fraction of Americans who are employed. And you can see the big decline by about 3 or 4 percentage points in this recession, and we got a little bit of it back, but not much. So it makes you think that there's a lot of barrels left in that basket, and maybe not so much tightness in the labor market, although the other view is so many Americans are unemployable because the mundane tasks are being done by microprocessors. The labor markets, the meaningful labor markets, are a lot tighter than this would suggest. Oh, did I do the wrong one? That's the Bush-Obama one we're in now. Sorry about that. But then what's really unusual, it makes it very hard to know what comes next. What's very unusual is the short-term interest rates, which have been totally flat on the floor since the beginning of the expansion, and we're threatened to go up in September. We're not. Maybe they'll start to go up in October. But it's a highly unusual thing. So that's already 2 things that are unusual. Low GDP growth, actually 3. Low GDP growth, very small improvement of employment to population ratio, and incredibly low interest rate. So we got to worry in particular whether that interest rate is going to have a big impact on either Main Street or Wall Street. Our view is it's not a Main Street thing. That 25 basis points, 50 basis points, is not going to have a big impact on Main Street. Wall Street's different because it has a tremendous psychological dependence on when and how much the Fed moves that interest rates. So another feature of this economy is that you need to factor into your thinking is that's the 10-year Treasury as of today. This is a record low 10-year, virtually record low 10-year Treasuries. And you need to recognize that in an environment with low real rates of interest, we should have high asset price. The price to price earnings ratios are high when the real interest rate is low. Your value of your home is high when the real interest rates are low. So this is still what the markets, equities markets, are still trying to sort out, the reality of low interest rates. The Fed doesn't have a big impact on the 10-year Treasury. It's mostly a global market phenomenon. So when it increases its short-term interest rates, what it does is it changes the slope of the yield curve, which is the difference between the 10-year and the 3-month rate. And you'll see as we show more and more of these that an inverted yield curve, namely when the slope of that yield curve turns negative, when the short-term rates are higher than the long-term rates, an inverted yield curve is an extremely good indicator of oncoming recession. So my advice to the Fed is as you move forward going into the future, it's a good idea to raise interest rates, but please don't give us an inverted yield curve because that changes business operations or banking operations in a way which puts the risk on, puts the concern on default and delinquency risk and comes with elevated lending standards that can really have an impact on the consumer markets, which are houses and automobiles. So here's where we are in terms of the slope of the yield curve now, a little better than 2%, a little higher than normal. The Fed needs to worry about flattening that out too much too fast. So the Main Street sensitive sectors are houses and consumer durables. Cars, when I say consumer durables, and houses are not in an overbuilt state. You can see this, all these images show you how many homes are being built. Typically it's 1.5 million homes, as you see across this image. Here in this recession, we went to incredibly low, only 500,000 units per year, and we're back up to what are traditionally recession levels, a little more than 1 million units. So the housing sector seems very much underbuilt, not overbuilt. Much driven by weakness in the household formation, which comes with weakness in the job market. The improving job market is coming with more household formation, more pressure upward on rents, and more building we see going forward. But the housing sector is definitely not overbuilt. And the autos are a little different. So here's the shape of the autos and all these. That's where we are now in the auto market, meaning that we went down to a low of under 10 million units in sales per year, up to these record levels of 17 million units. So it's one of the few sectors in the economy that you see a real V shape. The problem with that V is the upper end of that V is too high. We can't sustain that for a long period of time. Had we had many months above 17 million units, you would be in a situation of overbuilt automobiles. We don't think it's been up there long enough. You can see we've been underbuilding automobiles quite a while, and we're only back to 17 million units now. So we do think, though, that the subprime lending in the auto sector will be more difficult going forward when the Fed starts to raise interest rates. The auto sector could suffer a temporary impact from that rate increase. But we don't think it's going to be decisive because the fleet is still aged, and as long as the job market is strong, people are going to continue to buy automobiles. So here's our forecast, but I warn you that I saw on Netflix a story about the Titanic, which I hadn't heard before, which the watch on the Titanic was looking very carefully into the future, and they're expected to be able to see 3 miles ahead, but because atmospheric conditions had changed so much, they could only see 300 yards, not aware that they couldn't see that far. It looked like they could see way into the future. So that's my little warning about the accuracy of forecasting in an environment in which the atmosphere has changed. The U.S. economy is behaving entirely different, which makes the forecast having a guesswork, or let's say an intelligence level that is greater than it normally does. You cannot simply rely on historical numbers right now because of the unusual nature of the situation that we're in. So we think the GDP growth is going to be good going forward. We are expecting a strengthening of the labor market. On the left is the unemployment ratio, and that comes with hardly any real improvement in the labor market, namely the employment to population ratio on the right plummeted in the downturn by about 5 percentage points, from 62% of Americans employed down to 57%. And it's had some improvement, particularly lately in the last year. That's the strength in the labor market, real improvement in the labor market, and we see that continuing. So our forecast will come with continued decline in unemployment, but further real strengthening in the labor market with employment to population ratios elevating back to 59%. Still far below the 62 at the previous peak. Where we're sticking our necks out is with regard to inflation. We see inflation elevating. In part, the data over the last year or two have been contaminated by the wild swings in oil prices. So you can see the core inflation rate, which excludes food and energy, is a little different from the headline number. But we see the core elevating somewhat going forward, and the headline numbers elevating even more as the oil turns from a big negative in terms of inflation to a significant positive. And we are, I would say, rather aggressive with regard to the Fed behavior going forward. We had the wisdom not to call for a rate increase on September, but thought that once this thing starts, it's going to elevate at a fairly rapid rate to a normal level, but driven by inflation. Absent the inflation, you're not going to get the elevated interest rates that you see here, both the 10-year Treasury and the short-term Treasury. So our neck sticking out is not with regard to interest rates per se, but to our concern that we're going to move into an inflationary environment. Obviously, if we'd hired the Fed to create inflation, they couldn't have done anything more than they did. In fact, monetary authorities around the globe have seemed like they did everything to create inflation, but there's hardly any out there. We think this may be the beginning of some concern with regard to the inflation issue. And you can see in a couple of series. So this is the evidence in rents. This is what you see in front of your inflation rates. The primary residence at the top and the owner's equivalent rent at the bottom, and both of them have had a trend upward in terms of inflation rate. Concerned that this is something important. This is like 30 or 40% of the CPI, if I recall correctly. And then wages, this is employment costs. It's not clear yet, but if you look hard enough, you can see an increase in the rate of increase in the employment cost index. So these we think of as evidence of, a little bit of evidence with regard to inflation looking backward, but we're calling for a significant increase along with higher interest rates. So with that as a forecast, I now turn this thing over to our crack California forecaster, Jerry Nicholsburg.